The sell-off in U.S. stocks has caused global turmoil. In Asia, China has been hit particularly hard with the Shanghai and Shenzhen stock exchanges touching four-year lows. Chris, tell us a bit what's driving this.
Yeah, so it's clearly been a pretty brutal week for equity markets around the world, and China is definitely no exception. We've seen pretty substantial sell-off in both the Hong Kong and the mainland markets, especially among big tech firms like Tencent is a major company tracked by indices. We've seen a lot of sell-offs there. I think that you can kind of divide it a bit into two different dynamics going on. There's the first kind of global dynamic, especially centered in the U.S. You have rising yields on U.S. debt.
And the U.S. trade war issues as well.
Exactly, and of course, just negative sentiment in the U.S. for whatever reason is going to spill into other parts of the world. And then you also have kind of China-specific factors, especially on the mainland. So we've definitely seen some kind of lingering concerns about how fast the economy appears to be cooling, about whether and how much the Chinese government is going to step in to provide some sort of fiscal and monetary support. And that continues to be even over the past week. So that's obviously feeding into this as well.
So in the past, we've seen the government step in at times like this to prop up the price. Is this something that we can expect anytime soon?
Well, so that was definitely true in 2015. We saw regulators did a lot of different things, not least the national team is created, it comes into the market, and it starts buying up stocks in order to maintain certain levels or at least to kind of buttress the fall a bit. We also saw widespread voluntary trade suspensions, so companies stop trading on their stock because it's too volatile or whatever reason that they feel that they should give. And then we saw regulators do a bunch of other things, including minor rule tweaks that would kind of stop the worst of the sell-off from happening. I should say we haven't really seen that yet so far. So mainland markets are down, more than 20% this year. So far, officials have been pretty good at staying mostly on the sidelines. But I think it is a very important and open question as we go forward, because we're now starting to hear some voices within the Chinese financial community a bit more loudly calling for officials to take steps to intervene.
Right, and it seems like there are a lot more different factors at play this time compared to 2015. Is that fair to say?
Yeah, I think that's absolutely fair to say. I mean, one of the biggest ones is simply the presence of foreign investors. So, I mean, they've been in the market for a while, but especially this year with MSCI inclusion, we saw a lot of funds coming in via the Hong Kong Connects. So this will be interesting on many different levels, not least because it's already been a pretty rough year in the markets. We've seen a lot of, since MSCI inclusion, we've seen a lot of weakness in the currency markets. We've seen a lot of weakness in equity markets in the mainland. But I think even going forward, there might be potential for a bit of a learning curve. Chinese investors are already pretty aware of the tools that mainland regulators will use to step into the market, to stabilize it. Western fund managers, perhaps as a general rule, are a bit less familiar with that. So I think it's reasonable to think that it's going to be an interesting time going forward, again, if officials decide that they need to step up their involvement in the markets.
Yeah, that's going to be really interesting to watch out for. That's it for this week. Stay tuned for more breaking news.